Welcome back to the channel. I'm LAKEY Ryan. Today I am going to be valuing Zynga stock. I'm going to be using a discounted cash flow model in order to derive the value of Zynga stock. The reason why I'm valuing Zynga stock today is because one of my subscribers commented on one of my previous videos asking me if I could value Zynga stock. Since I already own shares of Zynga stock, I decided that was a pretty good idea to go ahead and derive a price target to see what the value of my shares are worth today. I'm going to go ahead and pull up my Vanguard account and see how many shares of Zynga I have. I don't remember when I bought them and I don't remember the price I bought them at. All I know is that they're up. So I'm actually really curious to see what my price target is going to be. Stick around, I'm going to show you why I initially bought shares of the stock, what the price of the stock is today, and my thoughts going forward on the company. As always, make sure to hit the like button as well as subscribe if you've yet to do so. I want you to be the first to know whenever I find undervalued stocks. So the most important metric when valuing a stock using a discounted cash flow model is the free cash flow per share. In 2019, since they don't have 2020 posted, it was 0.25. Now what's interesting is whenever I run a discounted cash flow model, I generally use 5 years prior free cash flow per share. However, the free cash flow per share was negative, and the first time it was positive was starting in 2016. So I'm actually going to go ahead and use 2016. So assuming we ran this model and we took 2019 free cash flow per share and we took 2016 free cash flow per share, then that would be saying that the compound annual growth rate is 103%. If we used a similar future growth rate, a discount rate of 10%, which is the return on the S&P 500, as well as the 3% GDP, that would give the stock an intrinsic value of $85.65 per share. Zynga is currently trading at $10.35. That means the stock would have 727% upside. So clearly the free cash flow per share is not going to grow at 103% on a future growth rate. That's just certainly not going to happen. To give you a comparable, Amazon's compound annual growth rate for the free cash flow per share has been growing at 78% per year. And that is like one of the highest I've seen of any company. That is Amazon. So assuming something much more realistic, and what I actually was using whenever I valued the stock to begin with when I went long, would be something more like 30%, because I think that mobile games is going to increase significantly with the rise of smartphones. And going with the 30% future growth rate, the 10% discount rate, it gave an intrinsic value of $9.80, and it's currently trading at $10.35. So my model is actually implying that under these assumptions, the stock should go down by 5%. I want to give you a little bit of detail so you can understand what's going on with this revenue. So Zynga was clearly struggling, and Mark Pincus, the original founder of Zynga, went and recruited Frank Gibeau, who was a long-term veteran at Electronic Arts for about 20 years, to become the CEO. He went on a turnaround mission. He came in and basically said, our return on equity compared with other video game peers is the worst. But what Frank did, and partially what attracted me towards investing in Zynga, is they went from 140 projects to about a dozen games. And what happened was, it paid off in spades. And then once they became more profitable, they started to expand into other franchises such as Harry Potter and Star Wars, etc. And they also expanded even into the Asian and other markets. So Frank Gibeau, and I'm not sure if I'm saying his name correctly, should really be credited with a lot of Zynga's turnaround.
Games have really proven to be a place where in quarantine you can kind of find a refuge from the stress. But more importantly, it's a great way for people to socially connect.
So I think that Zynga has high correlation with the amount of smartphones being used. And the data shows that each year, each day, more and more people are using smartphones. Beyond that, Zynga's games are free. They do have ads. Those ads sometimes can be annoying, but their games are free. So if more people are using smartphones and they're getting to play games for free, then that combination of that has allowed them to focus on growing their revenue and growing their free cash flow per share. So I'm going to go ahead and use a future growth rate of something around 40% for their free cash flow per share. I'm going to use the same assumption of 10% discount rate, 3% GDP, and this is going to give an intrinsic value of $13.98 per share. Now the current stock price is $10.35, which this gives a 35% upside. Honestly though, this seems a little bit bullish, so I'm going to go with something that's a little bit less. So this time we're going to use something that's in between, such as a 35% future growth rate. I understand where it may seem aggressive to have a 30%, a 40%, 35%. But if you really think about it, mobile phones are growing at a rapid pace. Zynga offers free products, and especially with quarantine, stay at home, or just the fact that more and more people are getting smartphones, it makes sense that Zynga is going to benefit tremendously from the smartphone boom. And beyond that, the revenue has been growing extremely quickly over the past few years. The CEO even said it himself. They had a record year recently. We're going to keep the assumptions the same at 10%. We're going to use a 3% GDP. And this is going to give us an intrinsic value of $11.74. At the current share price of $10.35, this gives an upside of about 13%. Now when I ran my model, I ran something very similar, and I, as you can see, got in around $8 per share. So when I bought my stock, it was showing me about 46% upside. Honestly, at these levels, I would probably wait to see if there's another opportunity to buy. If you could find the stock moving closer towards its 200-day moving average, around 950 or so, 950 or below, that would become a buy target for me. So to me, Zynga is a hold with a price target of about $12 per share. I am bullish on mobile games in the future. Like I said, I think that a lot of people are going to end up using their smartphones. Zynga has a business model where the games are free, and I think that in the long run, the stock will be fine. But at these levels, it is not attractive enough for me to issue it as a buy rating. When I make a video and I put a price target on a stock, I'm not saying that tomorrow or next week the stock is going to necessarily go to that price target. I am just saying that the intrinsic value, the actual value of the company, is worth this much per share. I'm literally here to teach you how to value stock, and I think that that's something that's very important. It's something that's important to me, and I want it to be important to you. So once again, if you enjoyed this video, please hit the like button as well as subscribe. It helps grow the channel. The next video is going to be on another undervalued stock that I found. I'm not going to tell you what it is. The only way you're going to find out is if you subscribe. Thank you for being here. I am LAKEY Ryan. I hope to see you again soon.